Hello everyone. Welcome to this another webinar that we have specifically kept on Monday evening to discuss particularly about the market outlook and guidance that Abacus wants to give to various clients as well as investors with regards to various portfolios that Abacus has been managing over last 3 years since their inception. Abacus has been able to build their name and has been able to cross 10,000 crores of assets as a mark based on the differentiated ideology and alpha focused approach that Abacus has been able to convey and communicate to the class of HNI and ultra HNI clients. Many clients have actually handed over great, I would say, faith in the hands of the able team members founded by Mr. Sunil Singhania at Abacus Investment Managers. And today we have Mr. Aman Chowhan, who is the senior fund manager and manages all the strategies across growth and emerging opportunities portfolios at Abacus across both PMS and AIF structures. We have seen that all the portfolios of Abacus have been generating good amount of alpha, if seen over last 1 year, 2 year with regards to their PMS products, and also, 3 years with regards to their AIF products, because AIFs were launched in 2018 and 19, but PMSs were launched 2020 onwards. However, the concern today is that though there has been decent alpha in last 2 to 3 years, but the alpha is actually not there if we see short term last 2 months. Obviously, 2 months as a scenario, as a horizon, is too short term for anybody to get concerned. But when obviously investment is in equity and the market is rising, and we see again the growth style of investing has started to kind of contribute, has started to become the flavor. Investors who are invested in Abacus are wanting to understand what is the market outlook that Abacus has today, what is the guidance that Abacus wants to share with its clients as well as with its investors with regards to how are they going to continue giving alpha over, say, next 2 years or next 3 years in long term. So this is the broad objective that we are going to cover. So we have in this format first, Aman Chauhan giving presentation on the market outlook and their own guidance and thought process with regards to how alpha will be generated in their portfolios in the first half of this webinar. Followed by this, we will take one is with me. You are most welcome to write whatever questions come to your mind, being an investor or being a prospect or somebody who is interested to make money in equity markets. Abacus is a, I would say, knowledge-rich institution with years of experience. We are here to answer to all your questions. Thank you so much for joining us for this webinar, and a warm welcome to you, Aman. So the floor is handed over to you. You can start with your presentation.
Sure. Thanks, Kamal, and I welcome everyone on this webinar for joining us. Kamal has very clearly put up the context that we, being a 4-year-old company, we have had a very strong track record, and the last few months is something where the funds have lagged the markets, and obviously, though it's a very short period of time, there could be some queries or there could be some concerns in the mind, and I hope that I will be able to address them well. The way I would take you through is that first, very briefly, I'll take you to the style of investing, how do we invest and how different we are. I'll take you to the market conditions right now, what is the market outlook, and then we'll come specifically to the portfolio as to what we have done in the portfolios and what going ahead is our plan. So coming right away, post the disclosure is first the investment philosophy and the strategy that we follow. At the time of investing, you would have gone through this slide, you will be aware as to what we do, but I'll just quickly recap. Abacus, this is the 6 point that we clearly believe in at any investment that we do in our company, irrespective of the strategy that you would have invested in. First and foremost thing that we follow is that we believe only in alpha investing. We all know about the benchmarks. We all know about the benchmark investing. Most of the funds or schemes would be following this practice of either being an overweight or underweight to a very large cap name. For example, say Reliance. Reliance is 10% the weight. The discussions in most of the places would be should we be 8% or should be 12%. In our company, we don't have this discussion at all of underweight or overweight. We'll buy a stock only and only if we feel we can make a positive return on this stock. Else, we're happy to look at something else or maybe even hold cash for a short period of time. So we believe only in alpha generation. We don't do benchmark allocation at all. Because of this, in the near term, fund performance can be significantly different from what the benchmark is, because my portfolio is completely different from what the benchmark is. Second, we do only fundamental investing. There is no technicals, no derivatives, no momentum trading, no quant models. Neither me, neither any of my team members do it. We do only bottom up fundamental investing. Third, if you look at the portfolios, almost 30-35% of the portfolios will be stocks where we are the first or the only institutional investor. And this is what differentiates my portfolio versus any of the other portfolios that you would have invested into. Now, what does this indirectly mean is that I generate my own ideas. And when I generate an idea, and if I'm convinced about certain stock or an idea, I am not shy to execute upon them. I'll not wait for others to join in. In fact, I am happy to be the first investor because that gives me a first move advantage. And how do we generate these ideas? We have a large investment team. We go to annual report. We speak with market consultants. We speak with management, and we do our own research to get these ideas and are not dependent on brokers. And that is the reason our portfolio is visibly different from what other portfolios would be. Fourth, we are flexible, we are agile. The portfolios are monitored on a daily basis. Anything that is not working, we have a 6 month of you can say holding period or review period, post which if things are still not working, we would like to bite the bullet unless there's a compelling reason to own it. In India, this is what we have learned from our past 2 decade plus of investing, is that if things don't work, typically we end up in first half, that second half will be better. And in second half, we say the next year will be better. And the story goes on. So we're pretty mindful of this and very clearly, if something has not worked, we don't mind biting the bullet and moving on. We are patient investors. We invest with a 3 to 4 year investment horizon with a broad idea that in this period, stock should double with a combination of both earnings growth as well as PE rating. And the sixth and the very important point is the risk reward equation. Any investment that I do, I look at this risk reward equation and it has to be favorable for me to execute any idea. What do I mean by risk reward equation? I have a very clear view that a great company may or may not be a great investment. It will become a great investment only if I buy it at the right price. And if I buy it at the right price, then my risk is less, my reward expectation is higher, and my risk reward equation is favorable. If it is not, then I would shy from making that investment. What this also means is that while we are not value investors, I'll not just go out and buy a cheap stock or a 5p stock or a 6p stock, but we are definitely value conscious investors. I do mind paying a significantly high premium. If the company is going by 10, 20, 30%, I don't mind up paying up to 30, 35p. But I definitely do mind paying a 70, 80, 90p just because the sector is in limelight, the stock has been a consistent performer, or you're a market leader, or you're a market favorite, or you're India's largest company, or the sector leader, and so forth. It could be multiple reasons, and this is very prevalent in India that the leaders, the sectoral leaders, as well as the index heavyweight, trade at a substantial premium. And I have nothing against these companies. These are great businesses, great management, great companies. But as I mentioned to you, not necessarily that all great companies are great investments. So only and only if we feel that this makes sense, the risk reward equation is justified, we will go ahead and invest in that stock. So this is broadly the investment philosophy that we follow. I'll come to this briefly post the market outlook. Now, clearly, you would all have been concerned as to how the market has been volatile. It has been almost a 2 year dream run post COVID. Nobody expected the market would rise the way it did post the initial COVID fall. And there was even a time when we all used to discuss that at the ground level, things are so bad, there is lockdown and the market continues to go up. And looks like it is disconnected with the ground reality. And most of the times, we all ended up seeing the same thing. It is global liquidity, which is rising all boats. It is global money, which is coming in. And that has led to a sentiment relating globally. To a certain extent, that was true, and we had a great 2 year rally. After that, in the last 6-9 months, things have been flattish to negative. Volatility has come back. It was initially with the Russia event, which was a shock and surprise to the market, post which now we are all discussing inflation and the interest rates. So these have been the two most talked about debates that we had. The situation today is that the same central bank, which was printing money and infusing liquidity post COVID, is now trying to reverse it in order to control inflation. What was expected that it's going to be a gradual 25 bips rate hike by the US Fed over a 12 to 18-month period has changed. They have front-loaded the rate hikes. We have seen 75 bips of rate hikes. We have seen 3 rounds of rate hike, and hopefully there will be one more round of rate hike before they pause. But this is what the scenario is. They have front-loaded because inflation has been much higher than the comfort of the central bank, and it has also been sticky. And part of this is also because of the Russia event, where the oil and gas prices, as well as there has been supply disruptions out of physical supply disruptions out of China. So the combination of factors which has led to this higher inflation, and the central banks are now responding towards it. Earlier, when demand was impacted, central banks printed money. They had no other way to infuse demand. Today, they are removing this liquidity. They have no other way to do it. They can selectively do it. They can change the timing. But as a central bank, the only thing you can do is manage liquidity, either give excess liquidity or you remove liquidity. And that's what is currently going on. The Indian government too, on its part, have had various announcements. It has put export caps, it has put taxation on export in order to dissuade companies from exporting, so that domestic demand is given a priority and the inflation here is controlled, or uh, is handled in a way the country wants it. Whichever way you put it, the fear today is that what is going to be this global situation, whether US is going to have a hard landing or a soft landing. Whichever word you use, stagflation, inflation, depression, uh, it all indirectly leads to the same question as to what is going to be the demand destruction owing to the high inflation and the rising interest rates. Coming to the markets, we had a sharp fall in March post the Russia. Markets recovered. June, July, again, we saw a very May or June, in fact, we saw a very sharp drop because of the inflation worries. As we speak, in the last month and a half, markets have recovered. It has again led to bulk of sentimental buying than anything changing at the ground level. In India, things were good and it continues to remain stable. But yeah, because of global events, markets uh, tanked, and it has also recovered because of global sentiment. Though specifically in the last few months, globally equity markets are not that recovered as what Indian markets have recovered. And I'll take you to the slides to highlight this. Specifically to mention here, in the last 3 months, when the markets are recovered, there has been a massive sector rotation. So the old favorite sectors of IT, pharma, chemicals, cements, these stocks have not performed, and the uh, underperforming sectors like auto angs, capital goods have been in the limelight, especially in the last 2 to 3 months. So this is the point that I was making, that Indian markets are volatile not because of any problem with the domestic economy. It was all due to global. And if you compare Indian markets with globally, we are among the best performing markets. If you see the on your right hand side, the 6 month thing, Nifty or Indian market is the only market which is positive. Otherwise, every other market has given negative return, and some markets are down even 20%. So while we might feel that a few months back we were negative, now we are flat to marginally positive, but it is still much better compared to any other market globally. India and Indonesian markets would be among the best performing markets at given any time frame, 1 month, 3 months, 6 months, or even 1 year. The sectors or the companies that have got impacted the most have been where the earnings growth has been elusive. Stocks which were trading on hype, trading on eyeballs, traffic, new age economy, fintech, and so on and so forth. And hence, Nasdaq is something where most of these companies are listed, and that has had the worst fall. In fact, Nasdaq index today, as we speak, is where it was pre-COVID. The whole COVID gains of Nasdaq has already been given off. As I mentioned recently, the broader markets have underperformed. Last 2 years, the mid and small caps have done well, which has not been the case in the current year. And inflation is what the issue is. So both the US inflation is almost close to 8-9% as we speak, and in India also the CPI is at 6-7%, but the WPI is running in high double digits. The bond market to me seems to have already discounting this inflation worries, because the bond yields have already started to factor in. They've already started to move up. They didn't wait for the Fed or the RBI to move in, and they started to move up almost 6 months ahead. And hence, I feel that the current inflation fears is something that has got well discounted by the markets. And why do I feel that the inflation is topped out? There are two reasons for this. One is a statistical reason, and the other one is on your screen, which is the commodity prices, which have all started to cool off. So from the highs, we have seen coal going back, cotton prices are down from the highs, crude is also now below $100, and agri as well as copper, steel, iron ore, they are all off from their highs, and some of them are even lower than the previous COVID. Now, there's also one more reason why we feel the inflation has topped out, and very soon we'll see a good number, and that is a statistical reason. See, whether we like it or no, inflation is calculated on a YOY basis. Something which was 100 rupees becomes 110 in 6 months. It's a 10% inflation, and we'll all be on the street shouting that this is not sustainable and we cannot live that way. But the same 100 rupees, imagine first goes to 105, stays there for a few months, and from 105 it goes to 110. In this scenario, what will happen? 100 goes to 105, it's a 5% inflation. From 105 it goes to 110, it is another 5% inflation. And nobody is bothered, nobody is worried. In fact, we'll have economists and strategists coming with reports saying that 4-5% inflation is good for the economy. It means that demand is more than supply and so forth. What is the end impact? The end impact is 100 and become 110, both in the first scenario as well as in the second scenario. Just that in the second scenario, it has taken a slightly longer time, and hence we are pretty okay with it. And this, to me, is what even the Fed was waiting for. The Fed also knew that it has printed money and the inflation is going to come in. It was delaying the rate hike as long as possible so that the base effect starts to come in, and it had to eventually have very minimal rate hikes. The Russia event spooked everything. Oil went for a toss, commodities went for a toss, and what was the planned pathway for Fed took a hit, and that is what spooked everyone. Having said that, going ahead by October, November, the base effect for Indian inflation numbers will also start to become favorable, and from a high base, we'll see low single digit kind of inflation numbers coming in. In fact, there could be 1 or 2 months where we can even have a 0% inflation, and this is something which is going to be pretty positive for the markets. So the major worry that we see of inflation, at least for India and also to a certain extent globally, seems to be already peaked and already priced in. Besides that, what would be the other worries? There is a geopolitical worry on the Russian front and maybe on the China-Taiwan front. We are not experts here. Frankly, nobody knows what eventually is going to happen, what Russia has in mind. But for many months now, incrementally, there's not been any major negative news. The economic sanction stays, which we expect should stay longer than what anybody would be expecting. But needless to say, trade continues with Russia, though not directly, but indirectly. And yeah, the major issue has been on the oil price and on the gas price. So as we speak, Europe is the most affected region. Their power bills and their energy costs are up anywhere between 2x to 3x than what they used to pay, and that has had a significant impact on the demand. But yeah, that is where the maximum impact of Russia event is. But incrementally, we are not seeing any positive and any negative news coming in. We expect in a few months, or it could be a few weeks also, before things starts to de-escalate, because nobody is gaining out of this besides Russia, and hence I feel that the sanctions which people are coming, they could get negotiated, and there could be a midway path out of the Russian crisis. High oil prices, which was a big issue for Indian economy, our view is very clear. From 100 odd levels, we expect oil to be headed towards 75 rather than 150, which many economists or many uh, fund houses have been predicting. And the reason we feel it's headed towards 75 is because one, the output from shale gas and shale reserves is rising. Uh, Only few economies, only few countries gain out of a higher oil price. US and Europe both are mindful of this. If they start impacting the economy, I feel that they would have a relook at the sanctions that they have in Iran, Iraq, and there can be additional supply coming in from these regions. And third is the renewable energy. So, uh, not many people are aware. A few months back, European region has classified nuclear energy also as renewable and a green energy. Suppose the Japanese disaster, they were all planning to shut down the nuclear reactors. Now the situation is different. Instead of buying expensive gas from Russia, they feel it is better that they restart these reactors and use the nuclear energy versus burning coal or versus burning oil from Russia. Inflation and interest rate, as I explained, the worst is behind us. This The other major concern in the market had been the FI selling. For the last several months, we have seen relentless FI selling, and this has been historic. Never ever before have we seen this kind of selling. There is no clear answer as to why they have been selling, but two or three things that I would like to highlight here is that one, what we see as FI selling is only one side of the coin. The other side of the coin is the FDI inflows, which have been a record inflows. So what has happened in the last year and a half, the IPO market and the private market, the unlisted fintech space, the e-commerce space have been pretty hot, and they have received record inflows. Almost 80-85 billion dollars of money has come in. So the 30-40 billion dollars of money that has gone out via FI selling, almost half of that has come back into the IPO market, and I expect the balance half has come into the FDI market or the private investment market. And hence, net, from one hand they have sold, but from the other hand they have bought more than what they have sold. Earlier, it used to happen that the both had the hands were buying. So that has been a change this time around. That there has been a secondary market sale, but we also don't know as to what could be the exact reason. When we speak to our colleagues or we speak to our friends or to our clients, they have everyone has a different reason. One of the most you can say common reason is that it's client decision. It's not a view on India. If FS has sold something, it is something similar to a mutual fund. This is what they tell us. Ultimately, it is a client money. The client has given us a redemption request, and we have to honor that. I might still be positive in India. I might still be positive on global equities. I still might be positive on a certain stock or the country. But if the client needs the money back, there is no questions asked, and we have to give the money back. Why does the client need money? Maybe because of higher inflation. Maybe it wants to spend more. Maybe because he has a currency view. Maybe he wants to deleverage. We would not know as to why ultimately the client wants the money back. The fact is the client wanted money back, and the FIs had no choice but to sell and return their money back. Having said that, I am pretty confident and pretty sure that once the dust settles in the developed world from where bulk of the FI money comes in, India would be a big beneficiary. I expect money to come back to India. One, India remains among the best performing markets. Whether you take a 1 year period, 2 year, 3 year, 4 year, India has by far been the best performing market, and hence I have no reason to believe that the money won't come back. And second, on a relative basis, also compared to our peers, we are today in a much better situation. If you look around, Sri Lanka is bust, Pakistan is bust, Bangladesh is in a bad shape. After the government intervention on fintechs in China, people don't want to go very overbid on China. Uh, Turkey, Greece, Portugal are reeling under super hyperinflation of 30-40%. There have been talks of one or two African nations where there could be a sovereign downgrade. European region, anyway, you don't want to invest into Russia, you don't want to Ukraine, you don't want to invest into related areas, and hence there are very few options left for anybody to invest. So there are a handful of countries and economies, say like Indonesia, Thailand, and India, which are doing well, and that is where bulk of the investor interest should come back to. And within this, India by far stands out by the sheer size of our economy. We are now the fifth largest GDP globally, and the kind of under penetration, the growth opportunities we have, and the kind of diversified, liquid, transparent markets we have. And hence, I'm pretty sure that We have seen in the last month or so, there have been days when FI selling has turned to FI buying. But once the dust settles, India will again be a big recipient of FI money. And on the currency, yeah, we are closer to 80, but it's more of a dollar appreciation versus case of INR depreciation. If you see the currency performance versus euro, pound, yen, or any other currency, INR has done well. It is amongst the best performing currencies as we speak. It is predominantly a dollar appreciation move, which has led to the rupee being at 80 levels. Having said that, broadly, INR will continue to remain a depreciating currency because that's what broadly the interest rate differential and the inflation differential India has versus other currencies, and that is eventually going to show up. But it works in a step fashion. We were around 75 levels, we have already moved to 80 levels. Expect rupee to consolidate near 78, 80, 81 levels, and after a gap, after 2, 3 years, maybe this 80 then again eventually moves to 82, 83. 80 is not headed to 70. It can go to 78 in the near term, but overall, INR will remain a depreciating currency. In old days, decades back, we used to depreciate 4-5%. Now we expect a gradual 2 to 3% annual depreciation of the currency. So that's broadly on the global front. As a country, as an economy, we are doing well. We are among the fastest growing economy. Post the open up, demand has been pretty strong, which is reflective in the performance of Indian corporates, and we expect this trend to continue. There's also a very clear shift which has happened in India during the COVID wave, which did not happen in Demon and GST, which is a shift from unorganized to organized. If you look around pre-COVID and today, all the large formal companies today are in a much better shape than what they was pre-COVID. Their working capital has improved, the data have come off, they have gained market share, and they are doing much well. But the mid and the small enterprises in India have been at the receiving end. They were not able to handle their working capital, labor, and they had issues and lockdown issues, and hence they were the ones which are impacted. Now, this is also getting reflected via the GST numbers, via the direct tax collection numbers, that we are seeing a clear shift here. Now, the good thing about equity markets is that only the formal economy of India, only the formal companies are represented in the capital markets. The cash parallel economy of India, which we all know about, is not represented in capital markets. So once the formal economy gains market share, it is all positive for equity market, and that's what we have been seeing, that GST collections and all the indicators are showing us that formal economy in India is gaining market share. And on the global front also, we have decent forex reserves, one of the highest, though it has come off of its peak, but still a very comfortable $550 billion of forex reserves that we have. We are not running a very high current account deficit. Our software export revenue or income is now matching all to the oil import bill that we have, so which is a very comforting situation, and that is what is also getting reflected into the currency. So bearing USD, we are among the better performing currencies. Rural economy is well. We had initial hiccups on the monsoon front. It was a bit delayed in certain areas, but overall, if you see, we are doing pretty fine, and hence I expect the rural economy to remain robust. Agri commodity, agri input prices are all up, and this should lead to good farm income for the farmers in the current season also. So last 2 years, monsoon has been decent. Even this year also, we are expecting this current momentum to continue. We all know how proactive the government has been. Slogans like "Make in India," "Atmanirbhar Bharat," which looked like just buzzwords a few years back, we have seen at the ground level things started to move in. The kind of capex announcement, the kind of new sectors that have come in, it's all clearly indicating that the government actions and initiatives are started to show results, and meaningful results as we speak. There's also one major impact which has been the China plus one strategy, and clearly India has been a big beneficiary. Post COVID, every large market, every large buyer would like to de-risk itself from China, reduce its dependence on China, and few countries like India, Philippines, maybe Taiwan are amongst the larger beneficiaries of this trend, and they are all benefiting. So earlier, what Indian GDP used to be, which was predominantly private consumption, now we have seen good amount of manufacturing also coming in. We have seen good amount of export growth also coming in, and this is helping new sectors to come in. So The traditional sectors are doing well, but now textiles have started to do well, garmenting has started to do well. India started even exporting bathroom tiles, which earlier we used to import, but now we are exporting that. Uh, so new sectors, new manufacturing avenues are coming up, and this is all giving more legs to the economy. Coming to the markets, post the fall and the recent pullback in the last month and a half, we are now almost closer to our 10-year average at 17, 18, 19 times forward earnings. We are closer to what it is. So I'll not say the market is cheap, but definitely it's not expensive. I'll say it's a fair valuation to be in. Uh, People can question as to whether 19 is or 20p is a fair valuation, because we used to trade at 15, 16 times a few years back. Uh, but at that point of time, the repo rate or the FD rate used to be 8, 9, 10%, which is now down to 5, and 5 has now moved to maybe 6, 6.5. From this background, just because the interest rates are lower than what it was, it makes a case that the P multiple should be higher, which is what is getting reflected here. So while we are not cheap, we are not expensive either. And for the ROEs that we generate, we are decently pleased, is what I would say. Corporate earnings is strong. Clearly, a shift from unorganized to organized also reflected you. And the corporate profit to GDP is also improving because new sectors have started to contribute. And this is all very positive signals for the economy and eventually for the markets. FI inflows and outflows, we discussed this, that we expect the money to flow back to India once things settle in India. And clearly, because of this reason, that India is by far among the best performing markets. A minute on this slide. If you see the past 20 years of uh, market performance, there have been 6-7 years where markets have given negative return, and in all these years, it has been due to a global event. Earlier, it was the dot-com bubble post FY20, then there was the subprime housing crisis of 7-8, then there was the Brexit, the Eurozone crisis, then we had the uh, current issue of COVID, which was also a global event. Bearing this global event, Indian equities had delivered decent returns, mid-teens to high teens kind of returns. Some years have been significantly better also. This year, so far it's flat. We don't know. Maybe it can end 5-10% positive, or maybe 5% negative also. But even if it is negative, it would be because of a global event. And history suggests that whenever we are down because of global event, it has been a buying opportunity. But India as a country, standalone, is doing much well versus what other countries or other markets globally are. So that's broadly on the market positioning. And coming to portfolio performance and the recent underperformance that we have seen, 2 or 3 things I would like to highlight here. First, there has not been a drastic change in our stance. So 2 months of underperformance is a very short period as such for us to move around, and we don't feel any major reason to look at. What has happened is that the underperforming sectors have come back, especially sectors like capital goods. But these most of the capital good companies today trade, the good ones, the ABB, Siemens of the world, they all trade at 70, 80, 90p, something which we are not very comfortable paying. At the same time, we feel auto and auto anchors is more of a tactical trade than a 3 to 4 year investment. They were down. They were hit by both higher fuel as well as higher commodity prices. Commodities have cooled off. Fuel is also looking down, and hence investor interest has returned back to auto. But we feel this to be more of a 3-4 month excitement than a 3-4 year excitement, and that is the reason we have dissuaded ourselves from chasing this momentum. This has led to underperformance in the near term, because on one side, my top holdings or my performing sectors are IT, pharma have given me a negative return, and on the other side, there are sectors that have done well due to my valuation concerns and my style of having a favorable risk reward equation. I could not participate much in the performing sector, and hence in the near term, that has been a double whammy. What we have done in the last few months would be we have increased our financial exposure. So we have added both banking as well as non-banking stocks, both in the large as well as in the mid-cap space. We like the rural market, we like the rural theme, and we are focused towards that. We have trimmed our IT exposure. We have not reduced it significantly because we feel that over the next 3 to 6 months, once the margin pressures and issues related to IT demand settles down, IT stock should do well. Today, what is the concern on IT? The concern on IT is that there is going to be, say, recession in US. If that happens, then what's the scenario? The scenario in recession is that country or the company don't close down. There's a slowdown in demand. When there's a slowdown in demand, what happens? You try to cut cost. What is a better way to cut costs for any American corporate that by giving business to Infineon TCS as $25 an hour versus giving it to Accenture 75 to $100 an hour, and to a company which has a business model which has proven even during the COVID time that there has not been a single day during COVID where your banking system was down or something didn't work. The IT moved smoothly even remotely, and it was a great performance in an IT company. And hence, because of this reason, and because of the migration towards cloud, we feel that demand should sustain. In the near term, obviously, the travel costs are back, and there has been a high attrition, which will have some margin impact on these companies, but it's a 1 2 quarter phenomenon, post which we expect the sector to come back. These are all great management, great companies, debt free balance sheets, and hence we have just trimmed our IT exposure, but not significantly reduced it. Focus on earnings growth stays, and the valuation for the portfolio at 10 11 times 24 earnings is at a steep discount to the market peak, and that is what makes me feel confident that bearing this near term underperformance due to sector rotation and due to we giving away some of the gains of the past, it was more of a mean reversion trade for us. Overall, over the next year or so, we will be able to come back and recover the losses that we have seen in the past few months once our sector also starts to perform. The slide here will highlight as to what I was mentioning. If you look at your top right chart, this is what the 6 months returns has been. In the 6 month Nifty has given you a plus 5% return, but IT is down more than double digit. Metals and pharma are negative, and what has done well is auto and cap goods, where we don't have a presence. And it's a simple combination of this which has impacted the near term performance. We expect this to reverse, and that's where we are pretty confident that with a 10 12 P, the portfolio is well positioned to weather this. So net, the call is pretty simple that globally, history has proven that as the markets are down due to global event, it has been a buying opportunity. India will continue to do well. We expect the same thing to happen with Indian equities. We expect a double-digit return from Indian equities to continue. However, the returns won't be linear. It can't happen that every year you get a steady return, because that's what nature of a bond market is. Equity market is a very different market altogether. We know the long-term trend, but at the same time, it is volatile. It is never going to be linear. A 15-16% return from benchmark and a decent alpha with a good fund is what one should be expecting. If somebody has a rational return expectation, he won't be disappointed with what we feel. Economic cycle is doing well. Modi government is doing well. Most of the negative news are discounted. We are fairly priced, not expensive, not cheap either. If markets have to correct due to a global reason, then we get into the value zone, and that would be a great opportunity. If not, once you start looking at investing right away and maybe come in via a SIP model over the next 3 to 4 months. Not a 1 to 2 year SIP, but at least a 3 to 4 month would be the ideal time, because then the benefits of Diwali, the markets moving up, will all start getting reflected in. So that's broadly what our market view and outlook is. So that's broadly the presentation from me, both in markets, sectors that have done well, not done well, reasons why the fund has not performed, and why we are confident that things should come back. The only thing I would like to add here is that we have not changed our style. So we are true to our design, true to our strategy. The first slide that I discussed as to why we are contagion investors, why we are different investors, why we are unbenchmark investors, we continue to stay hold to that strategy. And because of that, there can be there was even said during COVID fall, we had a negative return. There have been 1 or 2 months of performance up and down where we have been impacted, we have come back, and we are pretty hopeful and confident that this time around also the same thing would happen. So that's broadly from me. I'm sure you will be having any queries both on market as well as on the portfolio. I'll be happy to address them. Besides, I will just request if we don't ask single stock or specific queries, anything on sectors, anything on market, I'll be happy to address. Kamal, we can now take
Sure. Right, Aman. Thank you so much for your detailed presentation. It has been really, intuitive to know all those points that you've covered on India's economy, your portfolio's approach, and guidance. However, we need to now answer to some of the realistic questions that investors have written in the chat box.
Sure.
Some of them pertain to stocks, so we will not maybe focus too much, particularly on a stock, but we will take a cue from what the client is wanting to convey, and then answer them accordingly.
Sure.
So the very first question, which I thought is relevant, which has been asked over the chat box, pertains to the fact that though when markets were in conducive given your sectors in the portfolio, there were stocks in IT, there were stocks in metals, which had performed. To give a few examples like Mastec and Jindal, but those stocks, profit booking has not been done. So what has been the reason, why profit booking was avoided, and why now though the values have come down, obviously we are still holding those stocks. What are the views in this regards?
Sure. So as I mentioned, in IT, there was profit booking. We have trimmed our exposure. As far as steel is concerned, this was an overnight reaction from the government. The government came in with the regulation, and the very next day, all the stocks opened significantly low, and they continued to drift. And we didn't want to sell it at distressed prices. We feel once the inflation cools off, which is hopefully happening in the next 3 to 4 months, government will reverse its export tax or export ban decision, and this would have a good positive uh, feel to the metal sector. So it can languish in the near term, next 2 to 3 months, but then it will come back. That's what the view, and that is the reason we are not trimmed our metal exposure. IT, we did book some profits, and uh, that's the reason you will see that the IT exposure, not just because of price, but even because of profits booking, we see much lower IT exposure today than what it was, say, 3 months back.
Sure. So you also mentioned, in your latest communication that
Hmm.
markets have undergone sector rotation.
Yeah.
So what is it that Abacus is looking at in terms of the new sectors that are emerging, and what kind of rotation are you following in your portfolios? Because what we feel that at present, minimal changes have been done at least till 31st July. For the month of August, we are yet to see the fact sheets. So
Hmm.
if you have done any meaningful changes in the month of August, or you want to give any guidance based on the expected changes in the portfolio approach, focused on your approach of
Hmm.
trying to aim alpha, we would really want to hear your views in that
Sure.
regards.
So broadly, just not in the last 1 month, or say over the last 3 months. One, we have stopped increasing our pharma exposure. So pharma is where it is. We have stopped increasing that. We have trimmed the IT exposure. Uh, we have added exposure to financials, both banks as well as non-banking financial stocks. So we have bought, say, India's third largest private bank. To we have recently uh, participated in the QIPs of some of the microfinance companies. We have also looking at mid-sized private banks as we speak. So we have increased our exposure here. This is something that we have done. We have also gradually added on to building materials or the rural focus sectors that we like. So while we don't have a direct housing sector or real estate exposure, we play it indirectly through a tiles company or through a laminate company or through a poly uh, cable company and so forth. So we have been increasing our exposure to these sectors because we feel that the rural economy in India should do well, and housing as a sector has just come out of 7 8 years of flattish to a negative return for investors, and now housing looks set for a good 3 to 4 year bull market, both as well as volumes as well as the housing prices are concerned, and this is where our current focus would be. So you'll see the portfolios. You'll see there has been some churn. Some of the tail stocks, which were less than 2% of the portfolio holdings, we have exited many of those names, and you'll see good amount of financial stocks have come in over the last 3 months. Going ahead, we are on constant lookout. If we get something on the capital goods fund, on the engineering fund, where the risk reward is favorable, we don't want to pay 40 50 p, because uh, ultimately what happens in capital goods is that you don't have a brand per se. You have a technical advantage, but this is not something that deserves a 70 80 p, right? So, and the biggest thing in capital goods is that, unlike say an IT or something where you get into a client, you finish your work, then you have a maintenance revenue comes in, or you have an annuity revenue comes in. For a capital good company, you made a boiler, you made a turbine, you made an XYZ machinery, and you sold it. Once you sold it, for the next 10 years, that guy is not going to be your client unless he plans a new large capex before the machinery gets rusted or gets bad and it needs to be replaced. The replacement cycle in capital goods is not very it's very long, it's not short, and that is the reason revenues are lumpy, growth is lumpy, and it's not a steady growth the way we see in a consumer company or say in a consumer discretionary or in IT or say even in pharma. And for that reason, we feel that the 70-80 P multiple for cap good is not something which is really justified. Right now, there is a hype. Sector is not done well for a long time. Manufacturing definitely is picking up. Even I am positive on manufacturing, but we would, as I mentioned, a great company also has to be a great investment, and that happens only if you buy it at the right price. So we will preferably wait for a better price, a better value to get into this sector. We have limited exposure. We have some names, especially in the mid caps. We don't have large capital goods, say, but Anup Engineering or Iron Action or something like that. We have that in our portfolio. They too are doing decently well, and the focus remains that once we get a decent match, we'll definitely look into this sector also.
Sure. So, what is the view with regards to EV and green energy? Because these are two areas of opportunity if one wants to invest with the perspective of say 3 to 4 years. What are the views Abacus has in these regards?
It's a writing on the wall that EV is here to stay, and that's where the future is. Eventually, all the cars in this world will be EV cars, and there will be very few petrol and diesel cars. But yeah, it's still a 5, 10, 15 year journey for different economies as to how uh, early they are in adopting the EV. India is also adopting EV in a great way. But as secondary market investors, frankly, we don't have direct EV plays, or we have very limited indirect plays. Let's say like Tata Motors. Tata Motors also has the EV portfolio. Mahindra has the EV portfolio. But along with the EV, Tata Motors also has a Jaguar portfolio, which has operations in 20 countries. It has a manufacturing plant in UK, which is right now reeling in the high power cost, and there is a demand slowdown in UK. Then it has also a plant in China. It also has a plant in XYZ, and then it has a CV business in India, and it has a passenger vehicle business in India. And there are too many moving pieces. In that overall scheme, EV is a limited single-digit exposure it has. Same thing with Mahindra. Besides tractors, besides the Jeep, small EV play that is coming. So there are no direct EV plays in India. If there are companies like that, we will definitely be interested in key. But as of now, there is not much of direct investable universe, and hence in the portfolio, you will not find any direct EV plays. But if somebody is looking at unlisted market, somebody is looking at beyond listed equities, definitely EV is something that should be in one's portfolio. And for that matter, even green energy, whether it is hydrogen or any other technology.
So, what is the percentage of exposure that Abacus aims to add with regards to these two areas?
Uh, it will be in single digits because, as I mentioned, it's not that we don't like it, but there are not many, there are not enough stocks for me to look and invest into.
Right. What are the views views with regards to the real estate sector? The sector has been underperforming for almost a decade, but last 1 year we have seen the on ground the prices have gone up.
Right.
So, what are the views and how does your portfolio want to capitalize on this sector? Do you have any exposure? Do you want to add exposure? What percentage of exposure you would want to have?
So we are pretty positive on real estate. One thing one should bear in mind is that whenever there is a change or whenever there is a turnaround or whenever there is a new trend, the trend typically lasts for 3 to 4. It has never been a 1 year, 1 or 1 month trend. Same thing is true with real estate. When it didn't do well, it didn't do well for 6, 7, 8 years together. Now it has started to do well. It's been just 1 year. I think there's another 4, 5 years at least where the real estate will do well. The trigger point obviously was the lower interest rates, and we hit a low almost 6.5% on the housing loan factor. But having said that, there is enough pent-up demand. There is enough money which has been made, and every Indian who owns a house would like to have a bigger house, and who doesn't own a house would obviously like to own a house. I might like to mention one thing here is that housing in US is in a bad shape. New housing sales, new volumes are down 30, 40, even in some cases 50, 60% from the previous highs. And the reason there is that the 2% housing loan in US today has become 4%, 5%. And hence your EMI output has doubled. In India, I don't expect this kind of a impact because housing loans in India anyway used to be 7 to 8%. It hit a low of 6.5. The 6.5 becomes 7.5. For 1% hike in interest rate, I don't think anybody is going to defer the buying decision. In US, your EMI is doubling. Here, it is only 10%, and that's not something which is significant. And hence, I don't expect rising interest rates to have a meaningful impact on the real estate demand. In the near term, maybe 1, 2 quarters or 1, 2 months, there can be ups and downs. But overall, clearly for the next 3 to 4 years, real estate looks to be in a good shape. We don't have direct real estate exposure in any of our portfolio, but indirectly to capitalize on this, as I mentioned, we have building material companies like plywood companies, laminate companies, MDF companies, cement companies, which all benefits from this housing sector boom that we are expecting.
In the month of May and June, when markets were down, Abacus was holding around 20 to 25% cash in various portfolios, maybe 18 to 25% cash. However, that cash was not deployed in May and June. But then, obviously, when markets went up in the month of July, some of this cash was deployed. I'm sure some more would have been deployed in August as well. So what are the thoughts? Why was cash not deployed at a lower valuations? Because the approach of the portfolio is obviously to invest at a lower valuation. Now at that point of time, we were told that the portfolio managers are not comfortable at current valuations, and now when markets have gone up, the cash has been deployed. Obviously when markets have gone up, valuations have become all the more expensive. So this
Right.
kind of confuses investors and kind of they doubt on our advice when we kind of talk highly about Abacus. This is one question which I have not been able to get answer to. So it would
Right.
be great, if you can please address this question.
Sure. First thing is that the cash level that you are mentioning would be only for the new clients. If somebody is with us for a year or 8, 9 months, they would be 90% plus deployed. Anybody who has come in the last 6 months would be deployed anywhere between 70 to 80, 85% as we speak. Uh, we have always maintained this stance that we don't do allocation. If somebody comes in, it is not a mutual fund, and the very next day he'll be fully deployed. We'll deploy your money at levels at stocks where we are comfortable with the prices, which are comfortable with valuations. Now, clearly, market was volatile, and for that reason, we are a bit more cautious than we are normally were, and hence we are gradually deploying cash. In hindsight, yeah, it looks like May, June market had fallen, and it was a great time because in July and August markets went up. If you see in July and August, global markets were still volatile. It is only Indian equities, it is only one of few markets that have gone up. And frankly, yeah, our call here would have gone wrong. We don't take cash calls per se, yeah, but we never expected the markets to bounce back so sharply in such a short period of time. And if that would have been the case, then we would have obviously deployed more, hurting us in the last 2 months. Having said that, it is better that we follow our philosophy. We follow that we don't time the markets and we stick to that. Otherwise, there is no difference between us and any other PMSs, which every 3, 6 months would like to change their views and their strategy based on where the market is. You can do well only if you play to your strength, and we know our strength, and we have seen the outcome of the strength. If you look at my 4 year, 3 year, 2 year numbers, it will show as to how well we have done because we have played to our strength. Right now also we don't want to change our style. See, if tomorrow Sehwag, if tomorrow uh, for a test match we start playing like a 2020, it is not going to work. So what works in 2020 has to be done religiously, diligently, and what works in a test match has to be done in a test match way. The same thing is happening with us. We have a certain philosophy, we have a certain style. We don't want to diverge from that style. In the near term, next 1, 2 months, it has not worked, but then we should play to our strengths. And very clearly, the move in August was something which was a surprise to us. So we never expected markets to bounce because the global markets were not. Ultimately, why were we down? We were down because of global reason. Indian markets didn't fall because of any local reason, right? So when we fell because of global reason and nothing much moved in the global factor, we were not convinced about this rally. What happened was that the FI selling, which was relentless for several months now, for several days, they were either positive or they were zero, and that turned the sentiments. And obviously, the domestic liquidity is there. We are doing well, so we never had a doubt on Indian economy. But uh, India's decoupling and a sharp outperformance versus the global market is something that caught us by surprise, and hence the full cash was not deployed. Obviously, markets moved up, that gave us some confidence. that Indian markets can withstand. The FI selling also came off, and there have been days when they have done decent buying also. That made us change our view, and hence we also gradually deployed some cash in the month of August. So yeah, ideally June, July would have been great months, but we missed that. We can't go right all the time. The way stock market investing work is that you should get 7 out of 8 bets right out of 10. Nobody can get all the 10 bets right. So yeah, last few months have been patchy for us, but yeah, that's about it now. Uh, just hold on. We are aware, we are mindful of what's going on in the markets. We would not just like to blindly follow the momentum. And in the next few months, the balance cash that we have also will be deployed.
Sure, Aman. So now, since we have next Fed announcement in front of us around 21st, 22nd of this month, where it is again expected that there will be 75 basis points of rate hike. I do not know how will markets react. If you have any viewpoint you can give. Beyond that, I also wanted to cover, for new investors who may want to invest in your PMS, say the month of September, before or after the Fed monetary policy announcement. What are the kind of indicative, I would say, deployment in terms of cash and equities that you will be following, given that yes, now markets are again closer to their all-time highs.
Sure. I'll take the second question first. Anybody coming in is getting 70 to 80% deployed within a week's time, and the balance 15, 20, 20% cash will be deployed over the next 2 to 3 months. So it's not good that based on my market view, because I don't try to time the market, but this is the style that we follow, and we'll be following for the new investors also. Coming to the US Fed, I believe the rate hike is factored in. Everybody knows there's going to be a rate hike in the Fed meeting. Now, how the markets will react is something which is interesting, and I don't have a very clear answer, but there are two scenarios here. What happens is that if the Fed comes and says that this is a rate hike, but we are done with the rate hike, now we are pretty confident, or the next rate hike is going to be significantly lower than what the current rate hike is, markets are going to rally, saying that chalo, worst is over, interest rates have topped out, and things are fine. At the same time, if data point in US, which comes on an almost daily basis and on a weekly basis, continues to disappoint, markets can take two views. One is that it can get worried, the way it has been over the last several months, that demand impact is much higher. There is going to be a slowdown, there is going to be a stagflation and etc. And markets can continue to correct. And at one point of time, sorry, at point of time, the markets can also take this view that things are pretty bad, demand is significantly impacted, and I expect Fed to react. It is very clear, and this is what is the Fed himself has stated, that they don't want demand to get distracted. They want to school off this demand, not finish off this demand. And hence they will feel that any day the Fed can come and say that, boss, I'm done with rate hikes. Don't worry, if things get significantly worse or it goes out of my hand, I will get liquidity back. In the near term, I'll ignore inflation, but I cannot afford to have a significant impact on demand, because that can be a permanent demand destruction, and markets can rally. So for a negative data point, markets can work both ways. Frankly, nobody knows which way it is. It can become pessimistic saying that demand is impacted, or it can become futuristic saying that demand is impacted, but it is near term. I expect Fed to react positively, and there can be rate cuts also, or there will be no further rate hike, and hence markets can rally. It's a very tricky situation. All I can say is that rate hikes are known to the markets. It's no longer a surprise. That is not what the market is worried about. What the market is worried about is the impact on demand of these rate hikes. And I think it will take 3 to 4 months of data for us to very clearly conclude whether US is having a hard landing or a soft landing. If it is a hard landing, then in the near term, markets will be volatile before they start to pick up. If it is soft landing, then markets should take it by stride. Rate hike should not be that big a concern for the market.
This being 75th year of India's independence, we are patriotically, emotionally believing that despite the recessionary fears in UK and confirmed recessionary fears in US, India's economy is more or less decoupled. Apart from some of the export-focused sectors, other sectors are going to be very healthy, and hence India's economy can continue to keep growing at maybe closer to 7 to 8% as a GDP number. However, are there any data points, macro or micro, that Abacus has to present to investors to kind of support this argument that India's economy is more or less not going to be much impacted by what is happening in the West?
Yeah, clearly, we are just 3% of global trade, and hence, in a way, we are decoupled from what happens. At the same time, it's a domestic driven economy. We have a high savings rate, we have a favorable demographics, we have favorable underpenetration levels. These are all signs that demand in India should withstand. And plus, we have a proactive government and we have a great government at place. But these are macro positives that we all have. I would like to answer this in a slightly different way. We all know about the Indian positives, and I can spend 2 hours discussing about how well India is placed. But as equity market investors, one should also bear in mind that there are two things which matter. One is growth, and the other one is sentiment. As they say, for any stock price, what is the background to that stock price? What is the base to that stock price? It is EPS and P. EPS is your earnings growth, and P is the multiple that you give, which is linked to the sentiment of the market. EPS growth, I'm pretty confident India will continue to do well. It is P, which is what the missing piece or where people make and lose money is. Now, what practically happens when India's growth is decoupled to a certain extent? India's finances are not decoupled. FIs own almost 25% of India's market. Now, 50% is owned by promoters and government of India, which means that the daily trading and the daily float is the balance 50. Out of this, FIs own 25, which means they have 50% market share of the liquid float of the market. And this is a big number. So while the EPS can continue to grow, in the near term, this PE can expand a contract depending on how the global market is because the money is coming from there. We saw 7-8 months of FI selling and it had an impact on our market. IT and banking, where the FIs had the maximum exposure, are among the two worst performing markets for the last year and a half, predominantly because of this FI selling. So in the near term, while Indian economy will do well and as a GDP will do well, but the P can go up and down depending on how the global scenario is. So if there's a recession in US, the demand impact may be only 5%. But if they take 5, 10, 50, 20, $30 billion out of Indian equities, or the Dow has a 10-20% sharp correction, next day we'll open gap down. When we open gap down, it doesn't matter whether the GDP is growing or no. It is a sentimental impact which in the near term impacts us. And one has to be mindful of that and be aware of that. So we'll, as an economy, we'll do well, but in the near term, liquidity and sentiment plays a bigger role. And if something goes wrong with FIs in their home country, then impact of that will be visible in Indian markets also.
Last question, Aman. We have always heard Sunil talking about that though Abacus is having a differentiated approach, which is value style of investing, but value without growth has no meaning. We are
Right.
aware that yes, there is a decent value in both the portfolios, whether it is growth or emerging opportunities. One, you kindly cover what is the expected valuations of both these portfolios, but more importantly, if you can cover maybe over last 2-3 minutes, what is the expected growth in earnings from the respective portfolios, which is emerging opportunities and growth portfolios.
Sure. So FY22 was it's not a good year to compare growth because it is coming off of a distorted base of COVID. When you come to FY23, which is the current year and the next year, uh, both the portfolios have mid double digit plus kind of earnings growth, and this earnings growth is ex financials. If I include financials, then the growth rate is even higher, but that's not the right way to look at it because financial numbers, financial banks and others do get traded on a price to book multiple than a PE multiple, and the reported earnings for banks are very distorted because it also depends much on how what is the NPA and what is the NPA provisioning these banks do. So X of financials, it's a 15 to 18% kind of earnings growth, and with 12, 13 P FY24, the risk reward for the portfolio is extremely attractive. Uh, so that's broadly where we are. Some of the stocks that we would have sold in the past few months would also be highlighting the fact that either earnings growth visibility has got impacted into these names or something has gone wrong where the earnings has got impact, and that is the reason we are sold out. We would ideally not sell a stock just because the PAs were re-rated or derated. We would exit a stock where the earnings visibility has gone off, and that's a stance that we are going to continue. We'll not buy something just because it's a sector favorite or there's a frenzy right now, unless until we see decent, meaningful growth with a decent price. Only then we'll get into any new idea to speak to. The reason we have bought financials recently is not just to deploy cash. We are pretty positive on financials for two reasons. One, post COVID, the major fear of NPs is now behind us, and the valuation for the financial sector is also pretty positive because it has been one of the worst performing sectors due to the FI selling. And now, with a decent valuation and a decent, fundamentally positive view on the sector, we are deploying more cash into the financial. And the same is true for any other sector or any other stock that we would have invested into. Going ahead also, we will be maintaining this stance. We will invest only where we see earnings growth, and we will remain a value conscious investor. So while I'll not just blindly buy a 5p stock, but definitely I'll not buy a 50, 60p stock unless it warrants or it justifies investing into that name.
So to everyone, I will just like to kind of give my viewpoint after doing this detailed discussion with Aman, that we should keep our trust on Abacus and should not make any judgments with regards to last just 2 months of underperformance. It's a value style of investing which deserves a minimum time horizon of 3 to 5 years, and there has been a very high alpha. In fact, one of the highest alphas in the industry. If one sees these strategies over last 3 years or on since inception basis, and I can tell you, Abacus as a fund house and team is mindful and aware of the recent underperformance that their portfolios have been undergoing. And when they have been maintaining cash in the portfolio, that was also to do with trying to ensure that the alpha remains, and that is the viewpoint now. I am absolutely hopeful and wishful that alpha continues to be there, because that's the core positioning of Abacus as a fund house. And obviously, being the advisors, we are always vigilant and we'll continue to keep doing these discussions. If our viewpoint changes at any point of time, we'll tell you, before you kind of get to hear from anyone else. So at present, our viewpoint is something which I have already shared with you. Thank you so much for logging in today, and thank you, Aman, for sharing your time. It has been pleasure conversing with you.
Sure. Thanks, Kamal. Thanks for hosting me and being patient with us. And thanks for everyone for joining us. And just as a concluding remark, it's more of a mean reversion. It's more of a very near-term performance hit that we are seeing. We are aware of it, and we aim that soon we'll be out of this.
Thank you, everyone, once again. Thank you, Aman.
Sure. Thanks, everyone. Have a great day.